Imagine you open your email one morning and there is a message from your student loan servicer. The subject line says, "Action required. Your repayment plan is changing." You open it. You read it, and somewhere in the middle of all the words and plan names you don't recognize, you see a number. Your new monthly payment, it is not what you expected. It is higher, a lot higher. And you sit there thinking, I did not do anything different. I did not miss a payment. I did not take out a new loan. Nothing changed on my end. So why is the number bigger? That email is not fictional. That email is landing in the inboxes of millions of Americans right now in July 2026. And most of them do not fully understand what changed, why it changed, or what they are supposed to do about it. So today we are going to go through all of it, plain and simple. By the end of this video, you are going to understand exactly what happened, who it affects, and what moves you should make right now. Let me introduce you to Darius. Darius is 26 years old. He lives in Columbus, Ohio. He graduated 2 years ago with a degree in social work. He took out $34,000 in federal student loans to get that degree. When he graduated and started repaying his loans, he signed up for something called the SAVE plan, the Saving on a Valuable Education Plan. It was a program the government introduced that calculated his monthly payment based on how much he earned, not how much he owed. Because Darius works at a nonprofit helping kids in low-income neighborhoods, his income was modest. Under the SAVE plan, his monthly payment came out to $67 a month. He could handle $67. For 2 years, Darius went about his life, paying $67 a month, not thinking much about his loans. Then July 2026 arrived, and that email landed. Here is what happened. In July 2025, the United States government passed a new law called the One Big Beautiful Bill Act. That law made major changes to how student loans work across the entire country. Those changes kicked in on July 1st, 2026. To understand why this matters, you need to know a little bit about how student loan repayment worked before. For years, Americans with federal student loans had several different plans to choose from when it came time to pay. Some plans charged you a fixed amount every month for 10 years. Others calculated your payment based on your income. The lower your income, the lower your payment. The SAVE plan was the most affordable of those income-based plans. For millions of people like Darius, it meant small, manageable payments. Some people with very low incomes qualified for a payment of $0 a month while still making progress toward eventually having their loans forgiven. About 7 million Americans were on the SAVE plan. That plan is now gone. The government shut it down, and every person who was on it has to move to something new. Starting July 1st, 2026, the government replaced most of the old repayment plans with 2 new ones. Option 1 is called the Repayment Assistance Plan, or RAP for short. RAP is the new income-based option. Your payment is calculated using your income and how many people are in your household. Unlike the SAVE plan, RAP has a minimum payment of $50 a month, even if your income is very low. And for higher earners, payments under RAP can actually be more expensive than they would have been under the old plans. People who study student loans have been clear about this. Borrowers moving from SAVE to RAP will pay considerably more in many cases. Option 2 is called the Tiered Standard Plan. This one gives you a fixed monthly payment for a set number of years, 10, 15, 20, or 25 years, depending on how much you owe. The more you owe, the longer you have to pay. Payments are fixed. They do not change based on your income. And this plan does not include loan forgiveness at the end. Those are your 2 choices if you are a new borrower starting after July 1st, 2026. If you borrowed before that date, you have a few more options, but the SAVE plan is still gone, and the clock is ticking on some of the other older plans too. Now let us talk about who this actually hits the hardest, because the impact is not the same for everyone. The first group is the 7 million people who were on the SAVE plan. These are mostly lower and middle income borrowers who chose that plan specifically because it gave them smaller payments. For some of them, moving to RAP means going from a payment they could manage to one that genuinely stretches their budget. If these people do not actively choose a new plan, the government will automatically move them into the standard repayment plan, which does not consider their income at all. That could mean a payment that is 2, 3, or even 4 times larger than what they were paying before. The second group is people in graduate school right now or planning to go. The old Grad Plus loan program allowed graduate students to borrow up to the full cost of their education. That program is now eliminated for anyone starting a new program after July 1st, 2026. New graduate loan limits are now set at $20,500 per year and $100,000 total over a lifetime. For programs like law school and medical school, that gap between the loan limit and the actual cost of attending can be enormous. Students will need to find other ways to cover the difference. The third group is parents with Parent Plus loans. If you are a parent who took out federal loans to help pay for your child's college and you plan to borrow more after July 1st, 2026, you will have no access to the RAP plan at all. Your only option going forward is the tiered standard plan, which means a fixed payment with no forgiveness at the end. So what happened to Darius? He got the email telling him the SAVE plan was ending, and he had 90 days to pick a new repayment plan. He sat with it for a few days, unsure what to do. The email mentioned plan names he had never heard of. It referenced laws he did not know existed. It felt overwhelming. But here's the thing about Darius's situation that gives him one real advantage. He works for a nonprofit. That means he is already on track for something called Public Service Loan Forgiveness, or PSLF. It is a program that forgives your remaining loan balance after 10 years of working for a qualifying nonprofit or government employer while making consistent payments. Darius has been working at his nonprofit for 2 years. He has 8 years to go. The new RAP plan is eligible for PSLF. So if Darius switches to RAP, enrolls in autopay, and keeps working at his nonprofit, his loan balance gets wiped out in 8 years no matter what is left on it. For Darius, that changes the math completely. Yes, his monthly payment under RAP is higher than the $67 he was paying, but if the balance disappears in 8 years, paying a little more each month is worth it. The key is that Darius had to understand the options clearly before he could make the right call. And that is exactly what most Americans are not getting right now. Here is what you need to do, depending on where you stand. If you are on the SAVE plan, do not wait for the government to move you automatically. If you get auto-enrolled in the standard plan without checking your income, you could end up with a payment much larger than you need. Go to studentaid.gov, log in, check what plan you are currently on. Then use the loan simulator tool on that same website to compare what your payment would be under RAP versus the other available plans. Pick the one that fits your income and your goals. If you work for a nonprofit or government employer, check whether you qualify for public service loan forgiveness before choosing a plan. ARAP is eligible for PSLF. The tiered standard plan is not. That one detail could be worth thousands of dollars over the next decade. If you are a current graduate student or planning to go to graduate school, look carefully at your program's actual cost versus the new borrowing limits. If your program costs more than what federal loans will now cover, you will need to plan for that gap now, not after you enroll. If you are a parent with Parent Plus loans and you plan to borrow more for your child after July 2026, understand that the RAP plan will not be available to you. Your only option going forward is the tiered standard plan. Look at what that monthly payment would be before you borrow. And if you enroll in autopay right now, you get an additional 1% reduction on your interest rate. That is a small thing, but on a $34,000 loan over many years, it adds up. Here is the bigger picture of why all of this matters. Right now, 43 million Americans hold roughly $1.7 trillion in federal student loan debt. That is not a typo. $1.7 trillion. The rules that govern how those loans get repaid just change in a big way. For millions of people, the change means higher monthly payments starting now. For others, it means losing access to repayment options they were counting on. And because the emails being sent out about these changes are full of plan names and legal language that most regular people were never taught to understand, a lot of borrowers are going to make the wrong choice, or no choice at all. And getting auto-enrolled in the wrong plan is going to cost them real money every single month. This is not about politics. It does not matter which side of the aisle you sit on. If you have student loans, the rules changed. And knowing what changed is the only way to protect yourself. Remember that email we opened at the start of this video? The one that said action required. If you have federal student loans, that email is either already in your inbox or it is coming soon. When it arrives, do not ignore it. Do not wait. Do not let the government pick your plan for you. Here is your move today. Go to studentaid.gov right now. Log in. Check your current repayment plan. Run your numbers through the loan simulator. And if you work for a nonprofit or government, look up public service loan forgiveness before you decide anything. This is one of those moments where knowing the rules before everyone else does is worth real money, not in 20 years, right now. Hit subscribe if this video helped you understand something nobody explained clearly before. Drop a comment that says, "I checked my plan, so I know you actually did it." I will see you in the next one.